Hello, legal professionals and students. Welcome back to Legal Dwar. Today we'll explore the About To. Important definitions under Income Tax Act 1961, Navigating the Lexicon. But before we dive in, make sure to hit that subscribe button and ring the notification bell so you never miss out on the latest updates. Understanding the lexicon of the Income Tax Act of 1961 is crucial for taxpayers and legal practitioners alike. Let's delve into the core concepts and definitions that form the foundation of income taxation in India. Essential terms in the Income Tax Act, assessee. An assessee is an individual or entity liable to pay tax. This includes individuals, Hindu undivided families, HUFs, companies, and other categories specified in the Income Tax Act. Gross total income. It refers to the total income earned by an individual or entity before allowing deductions under various sections of the Income Tax Act. Income from other sources. This is a residual category encompassing income sources not covered by specific heads like salary, house property, business, or capital gains. Taxable income. Definition. Taxable income is the portion of income on which tax is calculated after considering exemptions, deductions, and other adjustments. Example: if an individual's total income is 500,000 rupees and deductions under Section 80C are 150,000 rupees, the taxable income is 350,000 rupees. Permanent account number, PAN. Definition: PAN is a unique alphanumeric identifier issued by the Income Tax Department to individuals and entities for tracking financial transactions. Example: PAN is essential for opening bank accounts, filing tax returns, and conducting high-value transactions. Advance tax. Definition: advance tax refers to the payment of income tax in installments throughout the financial year as opposed to a lump sum at the end. Example: a self-employed individual pays advance tax in quarterly installments based on estimated income. Tax deducted at source, TDS. Definition: TDS is a mechanism where tax is deducted at the source of income itself, such as salary, interest, or rent, before the recipient receives it. Example: an employer deducts TDS from an employee's salary before crediting the net amount. Assessment officer. Definition: an assessment officer is an official responsible for assessing the total income of an assessee and determining the tax liability. Example: the officer reviews the submitted income tax returns and may request additional information for assessment. Audit. Definition: audit refers to the examination of financial records and statements to ensure accuracy and compliance with tax laws. Example: the Income Tax Act mandates audits for businesses with a turnover exceeding a specified limit. Filing status. Definition: filing status indicates the category under which an individual or entity is assessed for income tax, such as individual, HUF, or company. Example: an individual can file income tax returns as a resident or non-resident based on their stay in India. Exemption. Definition: exemption refers to specific incomes or investments that are not subject to income tax, providing relief to taxpayers. Example: agricultural income is exempt from income tax under the Income Tax Act. Assessment year. Definition: assessment year is the year in which income earned in the preceding financial year is assessed for tax purposes. Example: for income earned in the financial year 2022-23, the assessment year is 2023-24. Surcharge. Definition: a surcharge is an additional tax imposed on the base amount of income tax in certain cases, such as high-income individuals or corporations. Example: a taxpayer with income above a specified threshold may pay a surcharge in addition to regular income tax legal interpretations and implications tax residency. The determination of an individual's tax residency status is crucial. The number of days an individual spends in India influences their residential status and, consequently, their tax liability. Capital gains. The Income Tax Act defines how gains arising from the sale of capital assets are taxed. Understanding the distinctions between short-term and long-term capital gains is essential for accurate tax computation. Deductions under Section 80. The Income Tax Act provides various deductions under Section 80 for investments in specific instruments like provident funds, life insurance, and equity-linked savings schemes, ELSS. Assessment procedures. The Act outlines detailed procedures for the assessment of income, including filing returns, scrutiny assessments, and appeals. Examples: tax residency residency in India. An individual spending more than 182 days in India during a financial year is considered a resident for tax purposes. Long-term capital gains tax. Gains from the sale of assets held for more than 24 months are treated as long-term capital gains and taxed differently than short-term gains. Section 80C deductions. Investments in instruments like Public Provident Fund, PPF, and equity-linked saving schemes, ELSS, qualify for deductions under Section 80C. Navigating these definitions ensures accurate compliance with the Income Tax Act, minimizing the risk of legal implications. Legal interpretations play a pivotal role in determining tax liabilities and obligations, emphasizing the need for clarity in these foundational concepts. Evolving lexicon. Amendments and legal interpretations. The definitions within the Income Tax Act have undergone significant changes over the years, reflecting evolving economic landscapes and legislative priorities. Example, previous year. Historical change. Initially, the previous year was calculated based on the English calendar year. The shift to align it with the financial year happened through the Finance Act of 1988. Legal interpretation. This change is aimed at simplifying tax calculations and bringing consistency by using the financial year. Agricultural income. Historical change. The definition of agricultural income evolved with amendments to include income from the sale of saplings, seeds, and more. Judicial precedent. Land leasing for agricultural purposes has been debated in courts, contributing to the evolving interpretation of what constitutes agricultural income. Capital gains. Historical change. The introduction of long-term and short-term capital gains tax in the Finance Act of 2004 marked a significant shift. Judicial precedent. Courts have played a crucial role in defining what qualifies as a capital asset, impacting the taxation of gains arising from the transfer of such assets. Judicial precedents shaping key terms. Judicial decisions play a pivotal role in interpreting and refining the meanings of crucial terms in tax law, providing clarity and consistency. Example, fringe benefits. Historical change. The Finance Act of 2005 brought fringe benefits under the tax net, impacting how companies provide perks to employees. Legal interpretation. Courts have deliberated on the nature of benefits, guiding businesses on what constitutes taxable fringe benefits. Perquisite. Historical change. The Finance Act of 2000 redefined perquisites, specifying their valuation methods. Judicial precedent. Court cases have contributed to understanding what qualifies as a perquisite, influencing the taxation of employee benefits. Minimum alternate tax, MAT. Historical change. The Finance Act of 1987 introduced MAT to ensure profitable companies pay a minimum amount of tax. Legal interpretation. MAT's scope and applicability have been subject to judicial scrutiny, shaping its implementation over the years. Understanding the historical evolution and legal interpretations of definitions is essential for taxpayers and professionals to navigate the nuances of the Income Tax Act. These changes often reflect the dynamic nature of the economy and the need for precise legal frameworks to address emerging fiscal challenges. If you found this video helpful, give it a thumbs up. Don't forget to share it with others who may benefit, and consider subscribing for more valuable legal insights.